that's what I was going to show you. It's got 3 by quality. Where did it lose? First, industry rank. Industry rank is quite high, 67, I think 67. So it gets only 2, so 2 points lost here. But I explained you that even is this company's food processing industry, it's a bit different because they also have a lot of integration in wholesale as a wholesale retailers. Okay, like retailers and wholesalers. So it wouldn't be just food processing industry. Timeliness, value line assessed it's 2, so it's got 6 points here. Safety, perfect scoring. Debt, lost 2 points here, and I explain you that it's only 3% miss. So if the debt was 3% lower, they will get maximum points here. Beta is 1, so it's not volatile company at all. But when the market is so volatile, maybe it's actually a good thing. Okay, because imagine if the market goes 30%, like we saw it, 20 or 30%. This company definitely is not going to go 20%. It's going to go much less down. But also, if the market skyrockets and moves up very, very high, Hershey won't do it. Okay, so if the market is booming and growing, Hershey probably will fall back. But right now, it's a good thing for us. Okay, so it won't fall as fast. Now, growth trend, you can see it's losing points here because of speed of growth, not the consistency, but the speed of it. Okay, and management is always great, fantastic, and pretty good one. So that's a quality one, but when we look at the price, we can see it gets a perfect score. I don't know, do you want me to explain how we come up to these ranges once again? Or, okay, timeliness is value line own projections about how fast company is going to grow during next year. So, and they have they take the biggest 1,700 companies, and what they do, they give score 1 to those companies which have a highest potential for growth. So here we get timeliness, I think it was 4. Okay, and that's why we give the lowest value 3. Okay, so 3 it's average. I think maybe it's changed yesterday in this case if it is 3. I think I was putting 4 even. So maybe now it's not 2, it would be 3 here. Or maybe 2 here timeliness. So we might get better score here now. So analyze it yourself, you will see it. So perfect. That's great. And no, 2.5. Okay, so nearly 2. All right. Okay, great. But then anyway, I always skeptical regarding timeliness because it's not my opinion, it's opinion of value line. Okay, even I pay attention to that, but it's not my thing. Okay, industry rank, why it's 1? Because it's 67, it has to be 2, definitely, value 2. It cannot be 1. Okay, we can check it. All right, okay, you convinced me, just a second. Okay, it's 67. Put 67. Maybe you didn't put anything there. If you don't know the, or maybe put 100. So it should be 2. Okay, and anyway, 67. Yeah, 57 has to be 2. Okay, again, going back to price. Is it clear why we have these numbers? Or do you want me to explain once again? Why we got the range between 95 and 100, 120 and 145, and 145 to 170? Put pluses if all clear and minus if you want me to explain it once again. Okay, all clear. Okay, fantastic. Now, we can see that based on the previous like valuation, like share purchase and prices, we can expect that the share price might drop to $95, and between 95 and 120, that would be a buying range. Above 120 to 145, it would be a hold range, and then it would be a sell range. So right now it's at $100 level, so 99.75. When I was announcing this masterclass, the share price, I think it was about $97. So it was very close, and based on technicals, I thought it's going to go to $90. I thought that would be the perfect time to entry. So I thought, okay, cool, exactly before our masterclass we have this drop and we can buy all together. But then for the last 2 days it actually was growing up, so $2 up from now, but still it might go down. Now book value, by the way, in value line it's 3.7. I want to show it right now because in reality it's much low. Earnings 26th of April, so we don't expect them during next month. So if you sell options or buy the share, so you have plenty of time like to work with this. Okay, so in any way, perfect company from the price perspective to enter a position. So we have $5 here, the risk that it can go to this level, and we have nearly $45 earnings potential when it goes to this highest hold range. Okay. That's what I wanted to show you also. It's financial report. You can download it from Interactive Brokers. And just want to compare quarters. You can see it was sold 1.97 products, $1,970,000,000 of products. This quarter was less. Probably that's also was the reason why the share price dropped, because they sold less than last quarter. Investors don't like it. But if you look at profitability, that's what we see, because they optimize their expenses. Look, here the profit was $742 million, right? And now it's 834 million. So it's what, nearly 90 million more, right, in sale, in like gross profit. And then we look at operating income. Here it was 221 million, and here 328 million. So it's 107 million more, even though they sold like 30 million less product. So it means that probably again what they did, they stopped giving discounts. They sold less product. They had much higher margin, so they had more profit in total. So this is a good thing to pay attention. Yeah, it could be seasonality, but we're comparing same quarter, 4 quarter here and 4 quarter here. Definitely there is a seasonality here. We can see, actually, if you go back to value line, you see the worst quarter is here in the earnings. So $1.15, 76, $1.05, $1.04. Here $1.09, 78, and with other investors, we were joking that yeah, people eating the weed. Like, remember that Australia is upside down, right? So if we take America, so they're eating all year long except springtime. Why they don't eat in springtime? Nona, tell us. What girls do before summer? They're trying to take their figure back to the norm, right? So after Christmas, they say, okay, fine, we have to eat less of chocolate, and because we're going to put dresses with a short skirt, and we need to lose some weight, and that's it. And Hershey loses some money, not loses, making less money right here. But in yes, that's you see maybe best sell here, but remember they're giving a lot of discounts during Christmas. They might sell more there, and actually yes, look at this. They sell much more. So 1.8 billion, and here 2 billion. They sell more, but they make less because they're giving a lot of discounts during Christmas time. Remember, when you go, you buy everything on discounts during Christmas time. Okay, from balance sheet, what I wanted to show you is like 5.5 billion, 5.5 billion here, and total liabilities 4.7 billion here, 4.6 billion here. So they have less liabilities, but if you so it looks like assets, they have more assets than liabilities, about what, $900 million in positive, right, in equities. 931 million in positive. What they have goodwill, which is 820 million, and they have other intangible assets, which about 360 million. So if you add them together, it would be about 1.3 billion, and they have 900 million in positive equities. So, and that's just air, it's nothing. So because they buy in companies all the time, so goodwill is growing, and they keep it on the balance sheet, or at least we don't see that they reduced it during last year. And if we calculate book value, intangible book value, we see it's negative. It's minus $1.2. So if you look at a company like that and you saw negative book value and the company had some issues, like fundamental issues from earnings perspective, growing perspective, and etc., you have to definitely take it into consideration, because if the company like that like goes to bankruptcy, investors will get nothing. There is nothing here, okay? Because whatever assets they sell, they have to pay the debt, and nothing will be left. Okay, but in our case, we look at the company which probably not going to go to bankruptcy for the next at least decade or something like that. Treasury stock, when company buys stock from the market, okay, they put it in treasury stock before they, destroy it. Do you understand what the treasury stock? Yeah. So treasury stock, when the company, for example, issue new stock, they issue stock, they quite often they cannot sell it as straight away, because if they sell everything what they issued, they might affect the price, especially if it is a big issue. So what they do, they put it in the treasury and they release it in small portions, okay, in order not to affect the price. But when they buy it back from the market, they also put it in a treasury stock, but they have to like destroy it. They have to cancel it out, and they cannot resell it back. Otherwise, if they bought some shares from the market and after that sell it back to the market, probably directors will manipulate it and make money on the share like trade rather than as a company. So in United States, they cannot do it. They have to, when they buy shares back, they have to cancel them out. Okay, so that's the trade. But before they do it, you see here they had some treasury stock here, and now they don't have it anything. So they canceled it. So just delete it. Okay. Okay, cash flow. We can see that operating cash flow is positive. Even like there is no third quarter here, so we cannot compare that. So is it the same level now? But what we can pay attention straight away, the dividends. They constantly pay dividends. Okay, and also issuing or retirement the stock, right? So you can see that they are retiring stock here. Here they issued new stock, and here retired. So constantly they're buying back stock from the market. Okay, so that's how much money they spent for that. So from operating cash, 625 they got, 465 they sold it. They gave away. Okay, that's for that specific company. All right, so guys, do you have any questions, fundamentals of this company? Is everything clear? If it is, just put us. Okay, great.